everybody. It is Monday, January 16th, week 3 of 2023. We're getting ready to get started with. We got a holiday today, day off, Martin Luther King Day. And just what you're looking up on the screen, looking at last week, how we had the forecast, Monday, Tuesday, Thursday with CPI. Over on the right, you see exactly where we wound up. And on Friday, we were able to print 4,000. First time we've printed 4,000 since we fell out of it back on December 14th when we had the FOMC meeting. The day prior, December 13th, we placed the high for, actually, it's a triple top high, September, November, and December, right there at 4,100. And we fell out of it, and we have recovered from 38.77 on our low on Tuesday up to 4,000. Trade of the week last week, fantastic. Once again, a lot of guys got $2. The majority got $1. Some got $1.50. Anywhere from a 25 to 67% gain. I'm going to cover what I'm looking at for the trade of the week this week with a couple of little asterisk disclaimers to them because once again, last week as we went into it, we were looking very clean. We knew exactly what we were looking for. Everything worked out. Repeated it again on Monday. Same thing, what we were looking for. Now, we've got a little bit of an issue. And that issue is, I'll show you on my other spreadsheet. That issue is that we have closed green above the previous close 4 days in a row. We had it 3 times in a row in November off the November low, 3 in a row the week after the 2022 low in October. We had 4 in a row in September. We had 3 in a row in August. 2 times we had that in July. 4 times we had it, 4 in a row we had the week July 4 during that holiday week. And we had 3 in a row twice in May. This is coming off of the close. That's what I track. I track the close. Yesterday's close and today's close. Bring you back over here and show you what I'm looking at. And it's a little bit different when you look over there on stock charts because they look at the open versus the close. And as I've tracked back here, going all the way back to the beginning of the year, and you can see your candlesticks, you had 4, 4, 4, 4, 4, 4. Those are the longest streaks in a row, 4. And here we are at 4 going into this shortened week, which is the second week of earnings, but not really a significant week in earnings as far as it goes. This week, we've really, I was going to save that for you for the end. Made a mistake there. Oh, spoiler alert. Thursday, we have Netflix. I'll cover Netflix later on. That's it. There's really nothing else out there that's going to be reporting earnings this week. So it's Netflix. That's really about it. We'll go into that. But again, going back here, looking at stock charts, and what I'm looking at mainly is to show you where we are when these 4 in a row happen. And anyone who can remember what it was like back in March, you might want to think that you've got a similar feeling right now, but it's just not. And I'll make it clear. I am bullish. I'm bullish for 4,300, 4,500. I've got a projection for 5,200. I'm just claiming a little bit of caution and looking for a dip because that's where we're basically at right now. 4 in a row over here in July. You can see what took place afterwards. Here was your 4 in a row as we went into the September. Here was your 4 in a row in October. And we've got 4 in a row right here, right now. Now, zoom it out a little bit more. Bam, bam. And this is the weekly chart. Okay? So on the weekly, we've just had 2 in a row. We had 2 in a row. We had 2 in a row. Off of that June low, as we went up into that August top, very clear we were aggressively bullish back then. Still remember how we hit that top there in August. 4 in a row. 3 in a row back here in March when we were excessively bullish, putting up to that 46.37. And then 2 in a row back here after you had that January low. Completely different algorithm from back in 2021. Not going to compare where we are now to where we are here. But from a weekly view, once again, you can see here we are not overbought. The money flow index, looking at a 5-week money flow, it is just coming off of a low and flowing upward. So once again, I will continue to say that I am bullish, but I am looking for a dip. And in looking for that dip, I want to show you here trend lines. And I am not a chart pattern guy by any means. I'm not a chart pattern table pounder. A lot of guys out there are. I'm not. But I always will respect what kind of a chart pattern that we have. You see this rising trend correction over here, and you see the ascending triangle. Now, I'll bring you back over onto the SPX. And 30-day view is, or I'm sorry, a 15-day view is what I'm looking at here. Here's your 30-day view, and I'll swap you over to the Thanksgiving, which is where my chart is, and you can really see right here that you've got yourself a rising wedge, where when we gap down, because we had that aggressive gap down on Friday, we were down 40 points an hour before the opening bell. We gapped down 15 points when we wound up closing green on Friday. So it continues to look very, very much not a buying, but more of a short squeezing. And with where we are up here, I am looking for this to be a red week, meaning I am looking for us to close below 4. I do not expect us to break down below 38.85. I don't expect us to break down below where that low was from earlier in the week, that 38.77. That's as low as I would expect us to be able to get to. Anything lower than that, and we're in trouble because we're back to the bear market lines. We're back to this trend line, which was the November low, or the November low, December low before we fell out. We're back to that trend line again, and that's what we'd be looking at. Coming on to the Dow, I've covered this as well, and how we're at this pivot point at 34,000, 34,200, where we've exhausted it on multiple occasions, other than this move that we had up here into March and April, where we fell into it, we resisted it, and then we fell apart. We're right at to it again, and it's once again another one of those signals telling you that it's not a time to be bearish, but it is definitely a time to have some kind of voluntary participation on a put side, just to be able to have something there for a dip, but at the same time, not being aggressively playing the downside where all the 2008 charts were flowing all over the place up until a week ago Friday when all the bears were converted into bulls. Come over here onto the NDX, and again, the NDX, looking at a shorter time frame here, just so you can see this rising wedge pattern that you've got formed, with it not filling that December 15th gap. Hasn't filled that yet. SPX did. We didn't do it on the NDX. And wider out, showing you here how it's come to the most overbought it's been since we were back here on the October dead cat bounce, since we were back here on the run up into the September high. We're right up there at overbought. And then again, with tech reporting next week, not this week, but you've got all your major tech reporting this week, still 30%, greater than 30% from the all-time highs, still lower than the 50 retracement from the COVID lows, hanging right here at 50 retracement from the December 2018 lows. We're going to unfortunately need a little bit of a dip back down so that the NDX can have some power when tech reports, when the FOMC meeting takes place the week after that, if we are due to break out of this resistance area and start pushing up towards that 13,000 area. So a dip is prudent. Now, here we are on VIX. The VIX broke all lows on Friday. Broke down below that December low, broke down below the August low, broke down below the April low, broke down all the way to my 1811, And it's just now resisting over here, or not resisting, but it's just now revisiting where the VIX lows were when we placed the all-time highs on the SPX on January 4th, which is down here. I do not expect it to get down there. I do not expect it to get down there in any way, shape, or form. Looking at the daily chart and on the RSI, it is definitely pushing to the downside on the daily, because the daily is a day. It's not a 5 minute, it's not a 1 minute. But you can see you've got yourself a little bit of an embedded buy divergence that has been set up, that has been broken down through, and that has started to trap, in my opinion, some of the bears. What you have here on the 4-hour chart is a very aggressive buy divergence. And again, because we are dealing with a very, very short lifespan now, not like it used to be, where all of the volume is on 0 days to expiration. All volume is heading into just what's expiring today. Very little bit of volume is going out there 1 week, going out a couple of days. We're in a situation here where the VIX isn't as reliable as it used to be. It still is, but it's not as it used to be. The 10-year came right down to the 10-year, as I've shown you last week, right to that pivot, that 34.37. The dollar, same thing, broke below that 103.40, hit down to that 101.797, perfectly got a little bit of a bounce. So we're at a decision point. We're at a crossroads, and for that crossroads, what I'm looking at for this week is a red week. I am looking for us to close below where we closed on Friday, meaning below 39.99. That's what I'm looking at. And for that, got a couple of spreads up here, which this being the more aggressive one. The trade of the week for Friday, January 20th, being selling the 4,000 calls, buying the 4,005 calls. As of 5 minutes ago, before I started the video, the credit on this was $2.45, which is nearly 100%. A little bit less aggressive, looking at the 4020s and 4025s, selling the 4020s, buying the 4025s, picking the 4020s as it was the last close that we had in the 4,000s, right there at 4020. And that was after we had fallen out from the December open, that 4151. Fell out of the 4,000s, went into the 39s, hit that 4020 CPI 4196, and then we sold off. So again, less aggressive, 4020, 4025s as of a few minutes ago, almost $2, which is almost 67%. Definitely going to be something that's adjusted because today is Monday, the markets are closed. The price will be adjusted as we get closer to the open on Tuesday, but this is what I'm looking at. Come over again onto a much less aggressive view with the selling of the 4050 calls and buying the 4055 calls. You're looking at about $1 credit, which is a 25% return. The reason why these credits have gotten much less than what we were used to is because your VIX has fallen apart. As the VIX retraces back to that major 2102, which I will pull up a second here, the VIX, and I'll bring you just on the 30-day. It gets back to that 2102, all of your implied volatility pricing will have increased, and we will be getting better credit once again. If we return above 2102 and start pushing back into that 23, we're going to start seeing those 100%, 150% credit spreads every single day that we were getting constantly for the last 3 months. So yeah, just because of this dip that you've got here over here on the VIX, we're very much looking for to be retracing off of this big sweep down to 1811, head back up to that 2102, and any breakup above 2102, together with CPC getting back up of over $1, we're going to be looking at a little bit more of an aggressive downside on the SPX, and we'll be looking at a push somewhere down into that area with the gap to be filled. Right over here for your gap fill down to 39.18. and most likely see a visit next week over here in this 3908, 3885 area at some point next week. It's OPEX week, or I'm sorry, this week. This week. It's OPEX week, options expiration week. So there's a lot on the table for a lot of big boys in a lot of big ways. And I had the chance to pull this up and I didn't. And unfortunately, I'm going to waste some time here. But on January 20th, you have two expirations. You have the big OPEX expiration, and then you have the one that expires on 4 p.m. on Friday. So you want to make sure and you look at that and make sure you've got what you've got. And as you can see here, at 4,000, there's insane open interest. You got 155,000 open interest in calls at 4,000. You got 144,000 open interest in puts at 4,000. So you can already see right there where you're going to be looking to get pegged as you come into the opening bell on Friday. Now, Friday's obviously on its own. It's options expiration day. I've shared charts on options expiration day multiple times. But even here, looking out at SPX for Friday, there's zero volume. Or I'm sorry, zero open interest. There's nothing because everybody has all of their money over here on January 18th. Sorry, 17th, being Monday. You look at the volume that we've got here on Monday for when we're getting ready to open, and this is where your open interest is. You've got a little bit of open interest. You've got a little bit of volume that's taking place today because you can trade today if you have a account with Interactive Brokers or if you are international and you're trading from somewhere like Tiger Securities or with HSBC. But in any case, wrap it up. It's your guys' day off. Looking at a red week, looking at a week somewhere under or near that 39.45, no lower than that 38.85 area. So not being aggressively bearish, not in any way, shape, or form. Definitely looking for a little bit of a dip. But at the same time, while I have you here, I want to bring this up. I'm going to change this over to, which one is it? SPX. SPX, bring you here on a 1 minute chart just so you can see a little bit more accurate. Move the pricing up. That red line is at 40.10 and it's going down. Okay? That red line's at 40.10 and it's going down. Now I will adjust it back again and I'll zoom you out. You're not going to see it on a, there you go. There's your red line. Your red line is specifically drawn right at the very minute that these pivots took place. And that's the way that you draw your lines. When you're going to draw a trend line, you're going to draw it the exact minute that that pivot took place. And then it's only valid on your 1 minute chart. When you look here, you can see we came up here in August, we came up here in November, we came up here in December. We actually pierced through it for a few seconds there in December. And when you come over here and look at it on a 5 minute 30 chart, or sorry, on a 90-day chart, it looks like it's way up here in the 4100s. So accuracy is key when you're talking about trend lines. You've got to look at it on a time frame where it actually calculates properly. So anyway, that's where we're at. That's what we've got going. And most importantly, because I messed up earlier, you are required to make money over these next couple of weeks because Valentine's Day is coming. And this Valentine's Day, you really do need to impress her with something expensive. You guys have eggs. I have onions. So have a fantastic Monday. I will see you in the chat room on Tuesday. I'll have an email out for you tomorrow morning, as always, prior to the opening bell. As of right now, really quick. Where are we? Futures are open, and we're down 46 points on the NASDAQ, down 12 points over here on the ES. The 200-day moving average is going to be our main break. Anything below that 200-day moving average around 39.85, we're going to be looking down there at that 39.30 area. It's going to take a day or two, but we've been built up, we've been pent up, we've been ready for this. So have a good day. Catch you guys later.